Let's speak about the state of the EV market right now and also the risks associated with EV stocks, growth stocks and speculative stocks in general. What is happening, investors? It is your boy Jack. I am not a financial advisor. And today we have a little bit of a different video. So today we're not going to be speaking about any one stock in particular, okay? I really want to outline what it means to be a growth stock investor or somebody who invests in speculative stocks. I want to speak a little bit about the psychology behind it and most importantly the risks associated with these kind of investments. So often when I speak about EV stocks, okay, I've said about Workhorse, about Lordstown, pretty much every single SPAC that's out there. Not all of them, but the large majority of them. Especially when it comes to EV. I've always said, they're high risk, high reward plays. And a lot of people only hear high reward. There's a reason that growth stocks are so attractive. It's because you can make hundreds of percents, not in a year, literally in a week, in a month. If you get in the right company at the right time, you can make absolutely insane amounts of money. But if it was that easy, everybody would just invest in growth stocks. There would be no dividend investors, there would be no index funds out there. Everybody would just invest in these really cool growth stocks. The reason, like with anything in life, we have such a high reward potential is because there is also such a high risk. And that's not something that enough people appreciate. I mean, people are very happy when they see their portfolios going up 10% in a week. But the last couple of days, we've seen the reality of it. We've seen the crash, We've seen a lot of weak hands get shaken out. We've seen a lot of stop losses get triggered. We've seen a lot of people who probably shouldn't be as heavily invested in growth stocks getting stopped out, and that is the truth of it. So today is going to be more of a casual conversation about what my thoughts in regards to these kind of investments are. How to know if you're overexposed to any one particular industry or if you're overexposed to growth stocks in general. How to handle your emotions when things aren't going your way, and why diversification is important. And that is coming from somebody who has a lot of their portfolio in EV. It really is important. So guys, if I could ask you to please hit that juicy like button, it would mean the world to me. I do genuinely think this video is going to help a lot of people out. If you're new around here, please hit that juicy red subscribe button and join the family. We just broke 40,000 subs, so 50,000 is the next big goal. And please drop me a comment as well. Let me know what you think about the video, and also let me know what your kind of thought process behind investing in growth stocks is, or what percentage of your portfolio they take up. But hopefully I can give you some value in this video. I do think it really is important to, speak about the risks of investing, especially in these kinds of companies. And this is something we actually speak about in my Discord quite a lot. So if you want to get full access to that, please hit the first link in my description and sign up to become a Patreon. It's a great community. But anyway, into the video. So a lot of you guys, I think, are like me, and some of your larger positions are in EV companies, specifically more than likely Workhorse, Tesla, Hyliion and Lordstown Motors. And we have had an amazing month. I mean, a truly amazing month. We have destroyed the broader market over and over again. There's a very common saying in life, not just in the stock market: what goes up must come down. And despite what a lot of people seem to believe, at the end of the day, stonks don't only go up, stonks also do come down. If we look at Lordstown Motors, okay, since the merger was announced, there really wasn't a dip. I mean, at all, there wasn't. We went all the way up over 200%, up to over $30 a share, with very few dips. There was, I think, 5% dips, and that was all, which is absolutely nothing at the end of the day, guys, when we speak about these kind of growth stocks. Now, in the last 2 days, we've seen a 22% dip. The market opens, as of recording this, in about an hour and a half, and we're down close to 8%, and I do expect a red day in all honesty. Stocks go up and stocks go down. And it's not just Lordstown Motors, okay? If we look at Workhorse, a similar story. We went up an awful lot. We've seen a very similar crash, very similar amount. I mean, Tesla, at the end of the day, a very similar story is unfolding, big red days. The same goes for Hyliion. They haven't been hit quite as hard, but there's still a lot of red in the market, okay? Why do I believe this is happening right now, okay? There's definitely a few different reasons. The first one I want to point out is what I already said. What goes up must come down. We've been on incredible runs, people, okay? Let's look at Lordstown Motors on the monthly chart, okay? And before this crash, we were up 121%. Now, that is a lot of money made. I know when we speak about growth stocks so often, it's not uncommon to see 100% happen in a month, and people become numb to that. 100% in a month is absolutely disgusting, okay? Put yourself in the shoes of, a long-term dividend investor. They genuinely are happy with 15% a year. If they had a 20 to 25% year, they would be over the moon. So in 1 month, we achieve what they would hope to achieve in anywhere from literally 5 to 8 years. Okay, so I can't stress that enough. This sort of price action is genuinely insane. And hopefully you can all appreciate right now that 100% gain is disgusting. It is nuts. But that is what we look for with growth stocks. But guys, if a company has the potential to move up that much that quick, it should go without saying They have the potential to go down that quick. And again, it's not just Lordstown. The same can be said for all of these companies. It was crazy. But if you look on the monthly chart, all of these stocks are still up so much more than the broader market. The S&P 500 on the monthly chart is actually down 5.66%. Lordstown Motors is up 72%. Workhorse is up 36%. Tesla is down about the same as the S&P, but we know how they've done this year. And then Hyliion is still up 12% as well. So in general, we've destroyed the broader market, guys. There's no denying that fact. It's been fantastic for EV companies. And when things go that well, there has to be a pullback. Now, why do I think it's been so aggressive, okay? There is genuinely a couple of reasons. So a sell-off began to happen because we've run up in value so much. You know, a lot of big players who are heavily invested in these companies may be taking some money out. A lot of people set stop losses on their positions. So a lot of people will do a trailing stop loss. So when Workhorse hit $30, for example, okay? A lot of people have a 10% trailing stop. So when that hit $27, they automatically sold out of their positions. Then there could have been people with a 15% trailing stop. So when we hit 25.50, they sold out of their positions. Then there's people with a 20%, and you get the picture. There's a lot of people with a broad variety of trailing stop losses. So simply put, some people could have set these, they even could have forgot about them and got stopped out, which would have contributed to the sell-off. The thing about this is a lot of time, people who run away with their profits fully intend on getting back into those companies. I mean, with Workhorse, we were up to $30 a share. That's absolutely insane. Some people got out at $27, at $25, fully with the intention of getting back in at a later date. Who knows where? I do think that's one of the reasons this is happening though. Literally people just getting stopped out. I think Tesla is dragging down the whole EV market. I don't like using that as a reason because it almost just sounds like a bit of an excuse, but I think we all understand Tesla influences the EV market. It really is that simple. And if we know anything about Tesla, we know they have potential to swing massively, and that goes for all EV companies. So Tesla's having a horrific time since the stock split. Despite an absolutely fantastic battery day, they've lost an awful lot of value since, and that is dragging down the rest of the market. I mean, even Hyliion, we literally have a massive catalyst the 28th of this month, and they are dipping. They've dipped all the way from above $55 a share. So Tesla is leading us down. There is actually a broader market sell-off. I mean, the S&P, the Nasdaq, everything's selling off. EV moves far more aggressively than the broader market though. So, you know, if the broader market's selling off, we're going to sell off a lot harder. Now, next up is just the psychology behind it, okay? There's a lot of people who bought in based on FOMO. There's a lot of people who bought in based on hype. Lordstown Motors, for example. A lot of people bought here between $28 and even $30 a share because it looked like it was never going to stop. I mean, Lordstown had so few red days, guys. So a lot of people just started to buy. They said they'd buy the hype. They didn't want to miss out. It's typical FOMO. They may not even really understand the company. They may see a video from me or another YouTuber making it sound great, but they don't actually understand it or how good of a company it is. And they proceed to lose 10% in a day and get very scared. And they sell. And then some people have lost 20% in a day. They get scared and they proceed to sell. And similar to the trailing stop loss situation I brought up earlier, it just leads to this snowball effect of people selling. If you guys watch my channel, you will always know that I say Tesla is not a company for you if you cannot handle the volatility. If you cannot handle 20 to 30% swings. Yes, 20 to 30% swings in a span of a couple of days. Look on the 6-month chart, you will see many examples of this happening both upwards and downwards. High risk, high reward. Don't forget the first part of that saying, high risk. I do think FOMO is a massive one. I think a lot of people want to be in growth stocks. They genuinely do. You know, they think they can handle it. They think they can handle the volatility. Until a day like yesterday happens, where people who are very exposed to certain markets lost over 10% in their portfolios. A lot of people don't have the stomach for that. You know, whether you have 1,000 invested or 100,000 invested, you're going to have the stomach for it or not. If you don't have the stomach for that, okay, if you have weak hands and you are going to sell, growth stocks aren't for you. It really is that simple. You might want to be invested in them. They are not for you. If you see a position go down 10% in a day and that shakes you, forget about it. Forget about it. It is never going to be for you. You are going to live a very anxious and stressed out life. It is not going to work. I'm sorry to say that, but it really isn't. You have to have the stomach for this game if you want the high growth stock plays. There's a lot of new investors in the market. I'm one of them, you know what I mean? But there's a lot of people even newer than me. And there's a lot of young investors in the market. I think more than likely more than there ever has been before. And again, I think a lot of young investors want the high growth and they think that they can chase the high growth, but they don't really see the consequences of days like this. And when they happen for the first time, they sell. And I don't think there's a more hyped up industry than electric vehicles right now. Now, I would like to stress it and make it extremely clear. I love electric vehicles, okay? As I said, they take up an awful lot of my portfolio. More than they should. Honestly, more than they should, and I will admit that. And more than they should for a lot of people. But that's me, and that's the kind of investor I am. I love it. You know what I mean? A day like yesterday, it doesn't faze me. It genuinely doesn't. It was my worst day in the market ever by far. I have a decent bit of money invested now. It didn't faze me. When this happens to you for the first time, and you see yourself losing hundreds, if not thousands, if not tens of thousands of dollars, and it's your first time, it's going to worry you a little bit. If you can't get on with it, if you can't put your phone down or stop looking at your broker for a while, forget about it. There's a lot we can take from Warren Buffett, okay? As much as he's a very, very different investor than a lot of us are, we can take so much from him. Warren Buffett's been so successful because of his diamond hands. I know he's invested in a lot of really safe companies, but look at what the man has accomplished as well. Look at his biggest position being Apple. He invested a long time ago. He's made so much money on Apple. It's not his standard investment, and it would have been considered a growth stock back then. Some people may well still consider it a growth stock. I don't think it technically is. But yeah, he didn't sell when there was a 10% red day or a bad piece of press. He didn't sell his bank stocks during the Great Recession. He bought more, and that's what makes long-term investing so important. If you invest in quality companies for a long period of time, the odds of you making money are quite high. Let me bring you back to Workhorse for example, okay? Because right now, in the short term, we're betting on a short-term catalyst, the USPS contract. That's what's going to determine these guys' price over the next few months, and it really is that simple in my opinion. I've said many times on this channel, okay? Workhorse, very high risk, high reward, very speculative in nature. But as time's gone on, they've become less speculative. You know, they've shown what they are going to be able to do. They've formed these strategic partnerships with companies like Hitachi. They've laid out the map for us investors to know what the future is going to look like, USPS contract or not. And so, say in some weird universe, Workhorse doesn't get any of the USPS contract. A lot of people will sell. You know, a lot of people will sell at $20, $25, $30, whatever it is, and will push the price down, just like we've seen happen today. For the record, I do 100% expect Workhorse to get 50 to 75+% of the contract, but we're in an alternate universe right now. A lot of people are going to get scared. A lot of people will sell. It is that simple in my opinion. And they might sell at a loss or a small gain. And I might hold Workhorse for 30 years. And in 30 years, Workhorse could be the biggest name in last mile delivery. And you will look back at a 6.3 or 8 billion or even $20 billion USPS contract and think, that's nothing. I mean, that's nothing compared to what they have today. That is the power of long-term investing. If you invest in quality companies and you can hold them through whatever rough times come to fruition, you're more than likely going to make money. It really is that simple. The longer you're in the market, the more likely you are to make money, unless you pick really, really bad companies and they go bankrupt. That's really the only way you're going to lose much money in this game. And growth stocks bring it to another level because you're trying to pick the company before they're the best. You know, that's really what you're trying to do in this game, and it's a whole other level of, you know, risk. I genuinely wish I could invest in Workhorse and just forget about it for 5 years, but unfortunately this is my job and I have to keep up to date with the company. I have to look at my account. I have to speak to people about Workhorse. I have a Discord group I have to manage. I wish I could just not hear about them for another 5 years in all honesty, because I genuinely, truly 100% believe that in 5 years Workhorse is going to be worth triple digits, USPS contract or not. In the meantime, anything, and I mean anything, could happen. And that's another thing. I mean, we have access to our portfolios all day, every day. We can see what's happening pre-market. We can see what's happening after market. We see what big investors are buying, what big investors are selling. There are people like Jim Cramer. There's an abundance of YouTubers giving their thoughts every single day. There is this constant supply of conflicting information on the internet in regards to every single stock in the world. I imagine 10 years ago, it wouldn't have been that accessible. 10 years ago, you bought your stocks, and that was it. You bought your stock and you hope that they go up. We live in a different world now. We really do. But when I'm investing in a company, okay, usually I like to ask myself that question. If I could invest in them now and not see them for 5 years, would I be happy? Now, there are definitely certain situations where, you know, I'd say no and I still would invest in the company. But with Workhorse, with Tesla, with Lordstown Motors, with Hyliion, you know, all of these big players, I would love to just forget about them for 5 years, but that's not something we can do. Next thing I want to speak about, okay, the scares of a second lockdown. That's throwing people into a frenzy. All I mean, we see things like this coming from Jerome Powell. The US economy is showing improvements, but the path ahead is uncertain. I mean, that's not going to fill anybody with confidence, is it? You know what I mean? They've essentially come out and said that, you know, they're going to need more funding. His printer is probably going to have to go brr for a while, and that's going to make some people nervous. And again, that's going to contribute to a large-scale sell-off. I think you guys are starting to get the picture. Now, some advice from me, okay? If the last 2 days have been painfully gut-wrenching. I mean, if this has really stressed you out, if you've been emotional, if you've been sad, you're too exposed. Honestly, you are too exposed to these markets, and I really mean that as a friend, okay? Your portfolio should not do that to you on a daily basis. If you can't handle this volatility, say for example you have a lot of money in growth stocks, whether it's EV, it's startups, it's small tech, you know, it's all of these innovations, it's 3D printing, it's the RQ, whatever it is. If you can't handle days like the last couple, okay? Honestly, I really recommend diversifying a little bit more and potentially having some of your capital in safer companies. That's not the answer a lot of people are going to want to hear. They're going to want me to say pump everything into Workhorse, but honestly, if it's that emotionally taxing on you, it is not worth it in my opinion. This should at the end of the day be fun. I know investing, you know, we're in it to make money, but as well you should be enjoying it, you know. It shouldn't be a chore, and it really shouldn't be causing all that much anxiety in my personal opinion. So if you are getting those sort of feelings and those sort of emotions, honestly, just do a little bit more research into a few more industries, a few more sectors. I mean, we're looking at a Lordstown open of down 10% again today, and to be honest with you guys, I'm not worried at all because of the kind of investor I am. If anything, I'm thinking, can I afford to put more money into the market this week? And that is the difference though, you know. That's what I'm thinking. I have a smile on my face because I think I could be getting in at a nice price. I could build my position for 5-10 years down the line. A lot of people are going to be thinking, oh, I just lost 10% of my position, I'm going to sell. But guys, really, I'm making this video just because I care about the mental health of you all, and I don't want it to be a really stressful journey. I also want to make it clear, there is nothing wrong with investing in safe companies, and there is nothing wrong with selling companies if you can't handle it. There is no shame in that whatsoever. It's your money, it's your portfolio. You have full control over it, my friends. But I do just want to stress the fact, guys, that if you are looking for the biggest growth, you are also looking at the biggest risk factors. And as well, I want to stress the fact you are going to make mistakes. I'm going to make mistakes. Every investor makes bad decisions. Every investor makes bad investments. They buy at the wrong times and they sell at the wrong times. We've even seen Warren Buffett, somebody I consider to be one of the best investors of all time, and a lot of other people do. Remember when he sold all of his airlines at disgustingly low prices before the majority of them went on a 70 to 100% run up? I doubt he's losing sleep over it. That's all part of investing. You will make good choices, you will make bad choices, and that's just the way it is. The most important thing is investing in companies you really do believe in, holding them for the long term, and making more good choices than bad choices. But anyway guys, I really do think that's the majority of what I wanted to say in today's video. Apologies if it's not as informative as usual, but I do think something like this can help a lot of people out. So guys, if you have watched until the end of this video, I really do appreciate you, and I really hope that I was able to give you, you know, some value and some confidence in yourself and your investment strategies. And of course, you, my friend, are a true legend, and I really do appreciate you being here. It is just important, you know, to understand what kind of investor you are and understand the risks associated with investing, especially if you're like me and you're going to be a growth stock investor. It's going to be scary at times, it's going to be gut-wrenching at times, and you are going to make mistakes, and you are going to lose money some days. Just remember, you don't lose money until you sell. That's the beauty of long-term investing. Anyway guys, if you did enjoy, could I please ask you to hit that juicy like button, drop me a comment, and subscribe if you're new around here. And also, if you are interested, please hit that first link in the description and sign up to become a Patreon. Genuinely is an amazing service. I kind of post a lot of things like this inside of there. I mean, when the markets are doing really bad, I always pop in and, you know, give my thoughts and try calm people down, and we all share our thoughts, and generally we all are in a good mood regardless of what the market's doing. There are a lot of people in there who will offer you a lot of value, I'll put it that way. It's not even just me. You also do get access to my buy and sell alerts, new ticker symbols I'm watching, we have individual stock chats for pretty much every company you can think of that we speak about. But anyway guys, I really do appreciate you watching today's video. I hope you have an absolutely fantastic day. I will see you for another video soon. Peace.